All right, so we can start recording, but I will be sharing the file with you first. Yeah. All right, the concept which I want to discuss with you today, the first concept is the beta. I'm not sure how many of you know, but beta is the concept that we borrow from mathematics, but it's the concept that we apply in finance. So this mathematical concept has an application in finance. And the reason we apply this concept is to know the systematic risk. I will not go in details, but I hope you know by the lectures that we had so far is that every investor is exposed to two types of risks, two categories of risk, not types of risk, I would say. The first category of risk is called systematic risk. The systematic risk is that which affects all and sundry. You can be a horrible company and you could be the best company in the world. You all are exposed to those risks. Whereas the unsystematic risk are your own deeds. As you sow, so shall you reap. If you're a good company, you don't have those risks. If you don't work well, you will come across those problems. I mean, you can be two companies in the neighborhood. One is very technologically advanced, very organized. They're very innovative in terms of their technology, in terms of their organizational structure. But the next door company is absolutely opposite. Now, there's no reason for a better performing company to become bankrupt. Only that would collapse, which is a bad company, Whereas if inflation comes, if interest rates change, if the exchange rate is going up and down, if the state's fiscal policy is changing, if the central bank of the country's monetary policy is changing, or even if you go away from the business and economic factors, if there is any political upheaval, if there is any climatic change, if there is a natural catastrophe, then you all are basically affected evenly, if not exactly evenly, but you all are exposed to that kind of risk. Beta is the measure of this systematic risk, which means all the measures, all the risk which basically every company is exposed to. All right. Now, the way we define beta is I think I better draw a picture, then it will be I would be in a better position to discuss with you. If I have this thing, the whiteboard, perhaps you can see it. I have one line drawn here already. If I take one more line here. So we have two axes, the x-axis and the y-axis. And if I call this bit as the company or the firm stock return, and then I have one more text box, and I call it the market index, because index, it could be, for example, S&P 500, depending upon what's your benchmark, S&P 500. It could be FTSE 100. If you are in Nordic, in Helsinki, Stockholm, Copenhagen, then you can use NASDAQ, Nordic 40, I think. There is NASDAQ, Nordic 40 index, which means the top 40 companies. So anyways, you have a market index. But I want to draw your attention, or rather I want to ask you, will it be a big deal if I swap this text box with this text box. So this goes here and this comes here. Will it be a big deal? Will it be a big deal? So this is the y-axis basically. Sorry. Yes. So this is y-axis. And if I can say this is the kind of x-axis. My point is that if I start calling market index on the, if I take it on the y-axis and the firm stock return, I take it on the x-axis, will it make a difference? Yes or no? It will make a big difference. It may not make a difference geometrically, but in its application terms, conceptual terms, it will make a big difference. Because we might have studied in our previous life that y is a function of x, which means y depends on x. When I say y is a function of x here, it means that y depends on x. In other words, the firm stock return depends upon the market stock return, but the market stock return doesn't depend upon the firm stock return. It's like saying that agricultural production depends upon the rainfall, but the rainfall doesn't depend upon agricultural production. Are you with me? So we need to know who is the cause variable and who is the effect variable. In data analysis, in statistics, in these kind of quantitative research, we call y as a dependent variable and x as a independent variable. So I can say that the market stock return have an impact on the individual firm stock return. Okay? And we have a straight line like this. Right? And here, this if you see here, this is when the market index value is 0. Just focus here. When the market's index value is 0, investor can still earn some positive, can they? According to the picture, they do. When the market index is 0, look, this is the 0 is the origin. The firm stock return, or you can say that the investors are still earning something. Or let's say that the firm must give something to investor. It's true. Because a firm must give at least the return equal to risk-free rate. If a firm is not able to generate return equal to the minimum risk-free rate, then why should people invest in your company? Because your company is riskier than the state. If I have the return from your private sector company 2%, and the Bank of Finland is also giving me 2% on treasury bill, I would trust Bank of Finland more than you. Because Bank of Finland is a much bigger institution, much financial backup. It's like a state security. Whereas the private company comes and go. I mean, some great companies collapsed. But I haven't heard in the last 20 years if any state collapsed because of financial problems. But the companies did. So therefore, this is like a minimum slab. The minimum return which the individual company must generate for its investors, because otherwise people would leave the company and they would rather invest in the treasury bills. Remember the question 1, task 1 is based upon this thing, that when the company's return go down, people go away they migrate, the investors migrate to the state bills, the treasury bills, and so on and so forth. Okay, question is that how does this picture relate to beta, systematic risk? Well, if you see here, I need to draw one more. Beta is measuring the slope. And what is slope? Slope is equal to change in y divided by change in x. So this is beta. You can see here that there is a change in y. If you see from this point to this point, can you see here this journey, this much? This is change in y, and this is change in x. And this is slope. Slope is basically the beta. Beta, the measure of systematic risk. And if your slope happens to be, let's say 1.2, if your beta is equal to beta, or let's say slope is equal to 1.2, it basically means that when, now you need to pay attention where the cursor is moving, this beta or slope, let's call it beta or slope. Make it added. Okay, beta or slope, it's one. Which means that if the market return, if the indexed value, if S&P 500 or FTSE 100 or whichever index you are using, in Germany you use DAX, in France you use CSE, whatever index you're using, if that index is increasing by 1%, this company's stock return is increasing by 1.2%. On the other hand, if this if the entire market is going up by 1%, the company's stock return is going up by 1.2%. But if the market is going down by 1%, the company's stock return is going down by 1.2%. Is the reaction of the company disproportionately more than the market? So basically what I'm trying to say is that when the company's stock, when the whole market is increasing by 1%, your company, the company which you think, or your portfolio, it could be one company, it could be a whole portfolio, is going up by 1.2%. So you are exceeding the market. But when the market is going down by 1%, you are going down by your return, your company's return or your portfolio's return is going down by 1.2%. Can I call that your portfolio or your individual company's investment is very sensitive? When we react more than, like for example, if your friend is teasing you, but your reaction is very too abrupt, you say, hey, stay away from this person, he's very sensitive. Because your reaction would be disproportionately more. It's like touching the beehive. So this is like the company, this company that, hey, this in the good times, it goes great and beats the market. But in the bad time, it goes down worse than the market. This shows sensitivity. And this sensitivity shows beta. If you are a risk-averse investor, or if you are a risk-neutral investor, you never like to have investment in a company portfolio whose beta is more than 1. On the other side, if you are a very adventurous, very risk-averse investor, okay, then you prefer to choose the individual companies and the portfolio whose beta is more than 1. Now imagine, in task 2 and 3, you have to give me a declaration that, Shab, I'm a risk lover, I'm a risk hater, or risk averse. We have 3 types of investors. Risk lover. Risk lovers are the one who pick up the individual stock or the overall portfolio beta more than 1. And risk neutral are those whose beta of individual companies or the overall portfolio is close to 1, like little bit, but not too far away from 1. And you are considered as a risk hater. We don't use the word hate, we use the word averse. You are risk averse. So we have 3 types of investors. We have risk lovers. Normally they have beta more than 1. Then we have risk averse or risk neutral. Beta is generally between 0.8 and 1. And then we have risk averse investors with beta less than or equal to 0.8. There's no hard and fast rule, but somewhere around 0.8. It's like it's not a kind of scientific definition, but just a matter of acceptance. Now imagine you are doing task 2 and 3, and you declare that you are risk averse investors. All right, and when I pick up your spreadsheet, all the calculations are fantastic, explanation wonderful, but I have a right to cut your marks. You know why? Because you declared that you would be risk averse investors and your beta is more than 1. Now here it doesn't matter how well calculation you have done, how great calculation you have done. It's a breach of promise. That's why in this course, just having those fabulous calculations are not enough. Okay, so be careful. And on the contrary, you declare that you would be risk lovers, but your beta is around 0.7, 0.8. No. That's not risk lover investors' strategy. They pick up beta, which is pretty higher than 1. So this is the measure of systematic risk. And this is called beta. Beta, I'm not saying beta is all about system. Beta is a measure of systematic risk. We have some other measures, but this is the basic fundamental measure of riskiness. And here we use the high school mathematics geometry, which probably is taught at 7th or 8th standard in the schools in maths. And here we apply that in the world of finance. Sometime when we are young, we study these things in high school. Are we going to use them in our life? Yes, we are using them in finance. Once I asked my teacher that, you're teaching me Pythagoras theorem, will I ever use it? And she said, Shab, at least once in life you will use it. And we do use them. We may not be aware of the fact, but we do use them, yeah? Any question about beta? We shall discuss how to calculate beta. Don't worry about that. But do you have any question? The concept of beta. So beta basically is change in y. Just see where the cursor is. Change in y divided by change in x. And if you have a company, let's say, okay, I can ask you a quiz. Actually, I can make a quiz here. Let's say this line. And I make one more line here. Sorry. Let's say this line here. 3 lines, yeah? Which of these 3 lines have high beta? There are 3 lines. Let's call them line 1, line 2, line 3. The starting point is same, it's fine, no problem, because the risk-free rate is common in the whole economy. Which of these three lines have high beta? Sorry, the top one. Because here, for the given amount of change in X, the change in Y is huge. But if you look at this line, for the same amount of change in X, the change in Y is very minuscule, very minor, negligible. That shows that maybe this kind of portfolio line is good for risk averse investor. This is for risk neutral, almost 45-degree angle. And if you're a risk lover investor, then you go for this. Okay. All right. So this is the theory of systematic risk. And now I can show you. The slide here. So this is the theory which I discussed with you. The good thing is that it's a standard measure. It's coefficient, right? You know the coefficient? Coefficient is a number free from units. When I say 1.2 beta, I don't say 1.2. When I say beta is 1.2, I don't say it's 1.2 million. It's just 1.2, a ratio, coefficient. Okay, so this is size neutral because there is no unit attached to it. Beta, you can find from some published sources, but in this course, we go beyond the published sources and we find beta by ourselves. Okay, that's a very important part. In this course, you can't avoid calculation of beta by yourself. For instance, if I have to show you, if I have to show you something else, where is the Kone? Yeah, this is the file which I want to share with you. This is Kone. You know Kone? Kone is a very well established, very well reputed, one of the best companies or one of the biggest companies in Finland, and it's a fantastic company. Now what I do here, I downloaded, because this is the last year's file, I downloaded this, this file last year, 2018, 2nd of May. And this data is for last, how many years? Oh, it's quite a lot. It's nearly, it's 12, yeah, it's 6 years data. And I hope you understand that in the last session when we met, I explained how you can download the data publicly from some database. And I told you last time that the only information that we require from a company's downloaded data is the stock price. Stock price. Which price? Not opening, not high, not low, average, not at all. Closing price. And look here, Kone closing price. Kone closing price. So these are the prices at the end of the day. Can you see there is 2nd of May and the previous day is 30th of April? It could be the weekends, or it could be that the market was closed. So it doesn't have to be to consecutive dates, but whatever date is available, the next, that's fine. And then I warned you not to do any calculation with the price, but with the return. And here you see the Kone return. Hi.
If you're seeing showing something on monitor, it's not showing up.
What? Oh my God. Okay. No, I didn't. Okay, I have to say it again. Sorry, because I forgot to resume the recording. I'll say it very quickly, yeah, because I want it to appear in the recording as well. So we have the company, the closing stock price, okay? This is 6 years from 18 to 2016. And this is how you calculate the stock return of the company's stock price. And these are the index values, but we don't deal with the index values as such. We convert the index value to the index return first, which is here. Same, the current price, bracket starts, the current price minus the previous price or the value, bracket closes, slash, oblique, divided by the previous value. And that gives us the index value. And then if you have 1, you have to take your cursor here. And when you see this small plus sign, if you click, it will go all the way down. Well, it's calculated already, but just in case, you don't have to do it each time. Now, because we have 6 years, and on an average, there are 250 working days in the stock market. So 250 multiplied by 6. So I would say there are almost 1,500 observations, a little bit plus minus. And then we come to beta. What is beta? Beta is the measure of systematic risk. And how do we reach beta? Well, we learned in the previous, when I draw a picture, that it's the slope function. And here we go. This shows the slope. So you can say that is equal to slope. When you type in slope, it will automatically come. Do you want me to do it all over again? Or is it okay? Should I do it absolutely all together? Or do you think it's fine? Slope, if you start typing is equal to slope, it will appear, believe me. Okay? Huh? Yeah, it shows. So basically it shows what is Y, what is X. Y is a symbol for the effect variable or the dependent variable. X is a symbol of or a sign of cause variable or the independent variable. So we always effect, and then so it comes automatically, no problem. I don't think there's any issue. And here the beta is 0.90, yeah? When you have Kone company and the beta is, so beta Kone is 0.90, yeah? So I can say it's 0.90 divided by 1. I can put percentage sign from my end, no problem. Now, basically, I am trying to say that when the whole Finnish market is going up by 1%, Kone stock return is going up by 0.90% or 0.9%, whatever you call it. All right. And if the whole market in Helsinki Stock Exchange goes down by 1%, then Kone stock will go down by 0.90% or 0.9%. Now, may I ask you one thing? If we have 3 categories of investors, risk lovers, risk neutrals, and risk averse, by traditional belief, norms or the yardsticks, for which type of investors Kone is more suitable for? Neutral. Can you highlight why so? Why neutral? Why? Absolutely, absolutely. Because any beta, which is more than 1, is for the risk lovers. Remember, there is no divine power which explains this rule, but it's just a matter of our acceptance. Okay, and if the beta is between 0.8 to less than 1 or around 1, it's more like a risk neutral. And if beta is below 0.8, then it's for risk averse investors. Okay, so I would say that if you're a risk neutral investor, or even a little bit risk averse even, because 0.8 and 0.9, they're not big C difference. In that case, if you are a risk neutral or almost at the bottom line risk averse investor, then Kone is not a bad choice for you. But if you love risk, if you really want to make big money, but at the same time you want to face the big risk, then I don't think Kone is a good choice for you. Look for some other company. So when you make a company's choice for your task 2 and 3, you have to be careful that sometimes you make a decision after choosing the company. All right, it's like who comes first? Yeah. Okay, now I carry on. Risk-free rate. You can when I highlight this, there's no formulation here. Do you know why? Because this is not given by the companies. This is not from the NASDAQ stock return. Risk-free rate is given by, I took this rate from Suomi Pankki's website. So if you go to Bank of Finland's website, like in this case, you can go, if you have the British companies, you can go to Bank of England website, but when you go to the central bank of a country's website. So my point to you is that the companies which you pick up for your portfolio, they should belong to the same country. Because let's say you have 4 companies, 2 from Germany, 1 from France, 1 from Finland, then the risk-free rate will not be same. So make sure that the portfolio which you pick up should be coming from the same country. Of course, in reality, you can pick company from all over the world, no problem. But then we make adjustments in our risk-free rate, which you can do actually, but I don't want you to do it. So let's keep it simple. Take the companies from the same country. Risk-free rate, when I see the Finland, the bonds issued by Suomi Pankki, the Bank of Finland, for 10 years, I came to know that the interest they're offering is nearly 1%. Okay, and I have full faith that Finland as an economy will not collapse in the next 10 years. So I can call it risk-free rate. All right, make sense? And here is the risk-free rate, 1%. And there's no formula, so I type it by myself, 0.01. And then, here is a trick. Kone daily return. I want to see if you invest in Kone for 6 years, how much is your daily return on an average? Sometimes you have huge return, sometimes you have less return, sometimes you have losses also, right? But what is the average? The average, you can see, I type in is equal to average. Is it called keskivaru in the Finnish computers? I think that you have to, but it's better that you follow the English because that will keep it simple. So when you say average, and I pick the data, C2 to C1524. Now 1524 is very interesting because I told you that on an average, there are around 250 working days in the stock market a year. So 250 times 600, 1,500. So it's approximately 1,500, yeah? Some plus minuses. This is the average stock price. Oops, sorry, yeah. This one, average. Okay, now here, I change the daily return to annual return. Why do I annualize the return? Any ideas? Why do I annualize it? We have the daily return and then I make it annual return. Any reason for this? Mm-hmm.
So it's easier to see on larger.
Yeah, I think it's good. It's good to see. It's better to say, hey, I invested in Kone and on an average, I earned 5% a year, rather than saying that I earned 0.000375 a day. Okay, so that's why as a mean of expression, as a convenient way of expression, we use the annual expression more than the daily. So what I do here, if I have the daily stock return, I can transform this daily stock return to the annual stock return, and believe me, it will not take much efforts. So what I do, if I have, what is H6 by the way? H6 is the average daily stock return. Yeah, Yarko, is it so? H6, if you see H6 here, H6 is the average daily stock return. And to the power of 365, 365. So it's like 365 here, plus 1 here inside the bracket. Don't ask me where this formula comes from. It's a arithmetic, so I can't explain where it comes from. And then we write -1. Okay. In Excel, if you want to put to the power of, we have to use the symbol arrowhead up. That means to the power of. Okay. And when we have this thing, we find that on an average, if you have stayed with Kone for 6 years, then the average annual return which an investor gets is 22%. It means if your investment horizon, if the time window you spent with Kone is 6 years, then on an average, you have earned as an investor 22% a year. Not bad. And then, are you interested in knowing that have you overperformed than the market or underperformed? Because when I say 22%, the story is incomplete, isn't it? Because it could be possible that the market might have grown at 40%. To me, 22% looks quite handsome, but maybe when I compare with the market performance, market would have performed much higher. All right, in that case, what I do, I find the OMX Helsinki daily return, which means how much you would have earned if you not invested in the company, but in the index, because you can invest in the index also. If you are extreme risk neutral, or rather risk averse, you rather invest in the whole market than the company per se. Okay, it's possible. So if you invest in the index, it comes out to be average E2 to E1524. And if you remember, E is the OMX Nordic, OMX Helsinki index return. And when you annualize it, it comes out to be the same formula which we applied to annualize Kone stock return. The only thing is that in here I take H8. H8 is the average daily index return. It comes out to be 19%. It means if you have an alternative to invest in the index for last 6 years, then your average growth would have been 19%. Can I say that Kone has outperformed the market? Will it be wrong to say, or can I say it? Kone outperformed the market by approximately 3%. Yeah, because if you invest in index, you only earn 19% a year. But if you invest in Kone, you earn 22%. Given that your journey is 6 years. So it's very important that how far is your journey. It could be possible that in 1 or 2 years, Kone has been beaten by the market. But when you take the overall 6-year period, aggregate, then Kone overall has beaten the market altogether 6 years. Now, the story will be incomplete if I only talk about return, return, return. What is missing from the debate? What is missing from the discussion so far?
Risk.
Risk. There we go. Now we go to risk. And here is risk. I will not disappoint you. I'll provide you, I'll give you a lot of risk. Okay. And here we go. The first thing I calculate is total daily risk. Remember? First we calculated daily return. And now we calculate daily risk, but total risk. Remember, why I never said total return. Did I say it? I didn't say total return. Why this word total comes here? Because we studied in slides that risk includes two things, two components, systematic and unsystematic. So systematic plus unsystematic is called total, but on daily basis, day-to-day basis. And what is the measure here? Standard deviation. I think we discussed a few times that if we want to find the one measure of total risk, it's called standard deviation. And it's very simple. All you need to do is type in STDEV something. It will show up, pick the formula and select the data. There we go. Very simple. The question is that, as this gentleman said, that we always like to show things in annualized basis, not on daily basis, right? And what I do here, when I have the individual, then I apply this formula, 1 plus K4 to the power of 365, because 365 working days, minus 1. This is the amount of total risk we face. Yeah? You with me? So 201, you can say percentage is the total amount of risk we face on annual basis for 6 years. Okay? And then we have, are you interested to know if you are not a very finance person, for you it's enough that, okay, how much is the total risk? But as a finance student, I think you would be thinking how much is coming from systematic risk and how much is from unsystematic risk. Yeah? 201 is total risk. What share of it come from market, the systematic risk, and what is the homegrown risk, that is the unsystematic risk? Well, in that case, we calculate total market risk, which is this. Sorry, total daily market risk. So, like you have the daily risk of the company, we calculate the daily risk of the market as well. And then we calculate the daily risk on annual basis. Whose return is more, Kone or market? Whose return was more? Annualized return. Whose annualized return was more, Kone or market? Kone. Whose annualized risk is more, Kone or market? Kone, of course. Remember the phrase, no pains, no gains. So if you get more return from Kone, you're also exposed to more risk as well. But when I see, now this is, you can be smart enough to judge it. When I see the ratio, this is 22, this is 19. So 22 divided by 19 is approximately 1 point something, yeah? But when I divide this risk 201 by 60 something, it's approximately 3.5 times. So the Kone's return is nearly 1.2 times than the market, but Kone's risk is approximately 3.5 times more. When you compare this number with this number, it's approximately 3.5 times, or at least 3.25 times. Okay. Now, how much risk is coming as from the market, the systematic risk, and how much is unsystematic risk? I wrote the formula: total systematic risk equals beta times annualized market risk, which means that beta, which is F2, remember F2 was here, if you remember, F was beta, which was here, F2 was beta, times K8. What is K8? K8 is the total annualized market risk. And this comes out to be 54 something. And then what is unsystematic risk? Very simple, leftover. K5 is total risk, total annualized risk. K9 is total systematic risk. The difference is called unsystematic risk. Difference, or the word residual. That is why when I was discussing with you unsystematic risk and what are the synonyms of unsystematic risk, I said firm risk, unique risk, micro risk, and one word I used was residual risk. Residual means leftover. Why leftover? Because this is total risk, this is market risk, and this is leftover. Leftover is unsystematic risk. And if you want to explain to your somebody that what percentage is systematic risk, well, I convert this risk to percentage. So 26% for this company, Kone, for last 6 years, 26% of risk is coming from the market, whereas 73% risk is within Kone somewhere, which is a big revolution, is a big finding. You not only know how much you earn on Kone, you also know how much risk you are exposed to. And you also know how much risk is coming from outside, that is the market, and how much risk is coming within the company, the unsystematic risk. This is called financial analysis. This is the fundamentals of financial analysis. And I take a pause here.